Welcome. My name is Jason Martin. Today is April 16th, 2020. Just wanted to hop right in here into the market and kind of give you guys a recap of the first quarter and jump into everything that's going on. And there's a lot going on. So I bring up this slide. This is something that we bring up pretty much every quarter as just kind of a review of what happened the prior quarter. And I'm going to go through this part pretty quick because this is kind of old news. The market's moving so fast now. In the last 2 weeks, a lot of these numbers have changed big. But just as a review, if you're a client of ours, you get a quarterly performance report, and this is what you'll see on those numbers in terms of what the market has done and what the benchmarks have done. So real quick, the S&P was down 19 for the first quarter, which are the large U.S. companies. The S&P 600, which is the small U.S. companies, is down 32%. The international and emerging markets, which is the MSCI ACWI index, mouthful, was down 23% for the quarter, and then bonds were actually up. So we often, when we talk to our clients about their portfolios, we compare them to an apples-to-apples benchmark. And these benchmarks are listed down below. These benchmarks are made up of these indices up top here. So obviously, if you're aggressive, you're going to have more of the stock side. In fact, you'll have 100% of the stock side. If you're more conservative, you're going to have more of the bond side. But an aggressive benchmark last quarter was down 23%, moderately aggressive down 18, moderate down 13, moderately conservative down 8, and conservative was down 2.6. So obviously it was a very, very bad quarter, the worst quarter since the financial crisis. And a lot of areas got hit really hard, especially small caps took a big part of the hit, but pretty much stocks in general took a massive hit. So let's jump forward and kind of look more now. Fast forwarding about 2 weeks to show where the markets are as of this point. So these are looking at yesterday's closes, and I'm looking here at the S&P 500. This looks back about 3 years, and it can show you kind of what the market's done. Obviously over the last 3 years, it's had a pretty good run. You had a pretty big drop in the fourth quarter of 2018, and then you had this big rally in 2019, and all of a sudden in about a 1 month time period you had a massive drop. The market dropped a little over 33%, the S&P 500 did during that time, and it's bounced 24% from that point. Now if you're doing some math and you're thinking the market dropped 33%, it's bounced 24, why isn't it a lot closer up there to that high? And the reason for that is that we're big believers in managing risk first, and this is why. A 33% drop takes a 50% bounce to recover. So to make that a little bit more extreme, a 50% drop takes 100% recovery or bounce to recover your full amount that you've lost. So, it's really, really important as we manage our clients' portfolio that, we do the things it takes. I'm going to get into this a little bit more about what we've done to manage that drop and manage risk, and to make sure that and try to avoid as much as possible any major drop. So that's the S&P 500.
And Jason, just to go into that, absolutely. Maybe you can go back to that slide and use a number. If I've got $100,000, walk me through that 33% drop.
So again, this is the S&P 500. This isn't our clients' accounts, but for the S&P 500, if you have $100,000. Okay, and you invested that $100,000 right there at the beginning, which I think was mid-February. That 33% drop, you're now down to $67,000. Okay, and then after this 24% bounce, you're really checking my math now. You're about up to like 82,000. So, but if 100,000, if you drop 50%. And $100,000 goes down to $50,000, to get back up to that $100,000, you have to go up 100%. So that's why it's so critical to manage risk really well, even if it means missing out a little bit on the upside when the markets are going up. So we're getting this question, and it's very relevant to this slide. It's the market took a pretty big drop recently, thank God, and I'm going to get into a little bit more about this. Our portfolios did not take nearly the drop of what the market did. But what I'm looking at here is just to kind of frame, what it would take for the market to recover over time. And let me kind of preface this by saying the market, the S&P 500, has always recovered from its prior drop, whether it be the Great Depression, whether it be any World War I, World War II, whatever, has been, the September 11th, the crash of 87, the financial crisis, the market has always recovered back up to its high. So obviously we've gone through a pretty bad drop. And what if it took, a full year to recover back up to those highs? From this point right now, if that happened, the S&P 500 would go up about 21%, 22%. If it took us 2 years to recover all the way back up to the market high, the S&P 500 would return 10% on average per year over the next 2 years. And if it took us an enormous 3 years to recover back up to that high, the S&P 500 was still average about a 7% return per year. So, it's good to kind of keep that perspective, knowing that, the market has always recovered from its past. And I'm pretty certain it will again this time. It's just a matter of how long it will take. So I think that slide at least was encouraging to a lot of people that I've shown. But so now getting into what got hit a little bit harder actually was small cap. So what does small cap mean? Small cap is basically large cap is the cap stands for capitalization. And for large caps, it's typically 10 billion and above. Small caps are 2 billion and below. So it's your smaller US companies. And actually, over the long run, small caps are the best returning of all the U.S. Size companies. Over the long run, they have the best return. But sometimes over the short run, they can be a little bit more volatile. And as you can see here, we're down 37% from the high this year and have only bounced about 8%. So, a 37% drop would take a 59% move higher to recover. So we're actually back to levels in small caps that we haven't seen since like 2015, 14, 15 timeframe. So definitely small caps have taken a big hit with this recent drop. And then this is international stocks, and international and emerging market stocks. They've dropped about 34% since the high in January, February timeframe, and have bounced 18%. So that's what's got hit. On the downside, that's what's taken a big hit, but not everything's gone down. And it's important for people to know that, because when you see the news and you're hearing how bad the markets got hit, they don't always talk about what has done well. And so one thing that has done well has been bonds. I'm going to talk about why that is, mainly because interest rates have gone down and they're a flight to safety. But I'm going to get more into that later. But the U.S. aggregate bond benchmark, which is kind of the standard benchmark for the U.S. bonds, it's up 5% year to date. And it's up 11% over the last 1 year. So, it's held up really well as stocks have gone down. And let's look at another area that, as part of bonds, is long-term U.S. Treasury bonds. So long-term U.S. Treasury bonds, these are 25 plus year, 30-year, U.S. government Treasury bonds. Around the world, these are known as a safe haven. And during bad times, especially going into a recession, you typically get a lot of large money around the world that is going into long-term treasuries. And plus, since they're long-term, they're most sensitive to interest rates. And just so you know how bonds work, when interest rates go down, bond prices go up. See, a lot of people, when they think about bonds, they're only thinking about the interest rate that you get from the bond. But when we go into bonds, a lot of times, and we were in this particular position, we're buying this because the price of the bond tends to go up as the stock market has gone down. So you can see here over the last 1 year, long-term treasuries were up 36%. And just year to date, they're up 24%. A big part of how we've held up so well as the market has dropped is that we've held a lot of long-term treasuries. And it's worked really well for two reasons. One, it's gone up as stocks have gone down. So for a portion of the portfolio, it's protected from those losses the market has had. At the same time, as stocks have gone down recently, it's given us an asset that we can sell as they've gone up to buy stocks that have gone down. So this is just a really good, a non-correlated asset, which means it's not correlated to the stock market a lot of times. It tends to go the opposite direction of the stock market, and it's a good diversifier in your portfolio. I'm not recommending to buy this, so please don't confuse, when I'm just talking about how they work. Because right now with interest rates, which I'm going to touch on in a second, getting down to zero, who knows how much longer bonds can continue to go up. But this has been something that's really helped out our portfolios this year. Another one has been gold. And this is a much longer term chart of gold. And the reason why I'm showing you a longer term chart is because when we were coming out of the financial crisis of 2008, 2009 timeframe, the Federal Reserve did what's called quantitative easing. A lot of people call that printing money, which is where they basically create money and they buy bonds with the intention of stimulating the economy. And the way that it stimulates the economy is it tends to keep bond yields low. And remember, when interest rates or yields are low, the prices go up. But for gold, when anytime you, so there's two ways that causes really currencies to go down, namely the dollar. And the reason you typically buy gold is for inflation. But there's two types of inflation. And one that most people are used to is when the price of things go up, the price of things that you buy go up. That's your typical type of inflation. The other type of inflation is when currencies get weaker. And there's two main reasons currencies get weaker. One of them is when the Federal Reserve, in this case, central banks, basically print money. That would cause your currency a lot of times to get weaker. The other thing is when the Federal Reserve or the central banks lower interest rates. So now with interest rates near zero and the Federal Reserve, doing a bunch of quantitative easing, and trillions of dollars worth of quantitative easing, we're entering a time frame that's similar to when we came out of the financial crisis in terms of zero interest rates and a lot of printing of money. And you can see here how well gold did during that time frame right here, where there was a lot of printing of money and there was a lot of and there was low interest rates. Now, we're not big believers in holding gold over the long run, but we do think it works well in an inflationary environment. And so we started buying gold last year, and just over the last 1 year, gold is up 34%. And year to date, it's up 14%. So we believe that if we continue to be in this time frame where the Federal Reserve is doing a lot of quantitative easing, interest rates stay low, and especially if central banks around the world keep interest rates low and do their forms of quantitative easing, it's a good time frame we think it's a good diversifier to own gold. And so that's been another reason that's helped keep our clients' portfolios from taking a big hit when the market went down. Now, switching gears a little bit, obviously it's a very difficult time from the standpoint of this pandemic that's going on. And for the things that I'm going to go over in a little bit, I don't want to sound that I'm not being compassionate. I'm just looking at this from a numerical economic standpoint. So please excuse me while I focus on the numbers and everything behind what's going on with the pandemic. So obviously there's going to be a lot of bad, and there already is. A lot of unemployment that's starting to happen, a lot of jobless claims and for unemployment claims, and just a lot of people that are losing jobs in general. The economy's starting to slow down at an unprecedented rate. And so the U.S. has its form of stimulus efforts that are coming out right now. And two of the main ones are the $2 trillion in fiscal stimulus. And a lot of people are getting some of those checks, whether it be personally as a family that they're getting, or in terms of helping out companies like the PPP Paul was talking about, to help small businesses keep people employed and continue to pay them. And then another form of the stimulus is the $4 trillion plus. It's pretty much, we don't know the exact number, but it's almost unlimited to the standpoint of how much the Federal Reserve has said they were going to start to basically do quantitative easing, again, printing money. And that number is changing every day. But my point here is not to be exact on the dollar amounts, but it's just an unprecedented amount of stimulus that is happening right now in the U.S. and around the world. And that can certainly help, but it's done a good job of kind of, trying to keeping the economy alive as we get through a time period, and hopefully that, that we come out the other side and the economy starts growing again. But just the stimulus alone is not the cure. And so what we really need, excuse me, what we really need is we need people to start to get back to the work, and the economies to start opening again, and people to kind of go back into a normalized form of life. So I'm going to use my charting skills on something that I never thought I would use charting skills for, and kind of show you different charts of the actual COVID-19. And again, I'm looking at this strictly from a number standpoint. I know there's a lot of death, there's a lot of people that have been affected by this, but I'm strictly looking at this from a number standpoint. And what we're looking at here is the number of cases globally, worldwide. And this is put out by the Johns Hopkins University. A lot of people are watching these maps on a daily basis now. And it looks as if, looking at this chart, in early April, we've peaked in terms of the number of cases. And you can see now that we've started to trend down in terms of the number of daily cases. Now, let me preface this by saying, I don't think the world as a whole is extremely accurate with the number of cases that are actually being reported. So what I think is more accurate is and I'll get into this in a second, is the actual death rates. But I'm still focusing here on the cases, and I'm looking at each individual country. So this is the US. Looks like we peaked a little bit later according to this chart. This is Spain, which is one of the hardest hits, along with Italy. You can see they peaked a while back. Same thing with Italy, Germany as well. China was the first one, assuming that the numbers are accurate, out of China, that has kind of peaked. In fact, their economy, they're already starting to go back and normalize their economy. You can see France up here that peaked a few weeks or a couple weeks back. United Kingdom is a little bit behind everyone in Europe in terms of peaking, but it looks like they've peaked recently. And then down here is Japan. Now, again, like I was saying, we have to use the data that we're given, and this is the data that we have in terms of number of cases. And I'm not sure how accurate the reporting of the cases are, but I do believe the actual deaths that are being reported are a lot more accurate than the number of cases are reported. So this is a really busy chart, I know, but bear with me as I explain it. So what we're looking at here is we're looking at a rolling 3-day average of confirmed deaths from COVID-19, and each one of these lines represent a different country. Now, what I want to make sure that, that you're aware of is that deaths lag cases. So obviously you would have to get the COVID-19 and then, you know, maybe spend about a 2-week period getting more and more sick and then eventually die. If you have, you know, passed away from the COVID-19. So there's about a 2 to 3 week lag time from when deaths happen. So, you know, if deaths are peaking across the world in certain countries, that means cases have probably peaked a couple weeks prior to that. So you can see Italy, in terms of its deaths, peaked on March 30th. Spain on April 4th, France on the 6th, Germany on April 10th, and then you have the US and the United Kingdom that looks like they peaked on April 11th. Now, I'm obviously not an epidemiologist, I'm not an immunologist, I'm not a virologist, and I don't know, you know, what's going to happen in the future. What my gift is tracking trends, you know, finding number patterns and those types of things. So I'm looking at this strictly from a numerical standpoint. But we often get the question, you know, and there's a lot of fear out there about what about a second wave? So let's say we do peak and the economies start going back to normal, you know, over the next weeks and months. And we've seen actually some news, you know, in a week or two ago, we heard the news of China starting to reopen. There is now some talk about Germany putting in a plan to open. Supposedly there is going to be an announcement from the president today about a framework for possibly reopening the economy. But so that's all positive. However, what if a second wave comes? And there's talk about that. And I think if the second wave does come, I think we're better prepared this time. Not just the US, but globally in general. So I think we're going to have more ventilators. We already do have more ventilators, obviously more masks. more awareness in terms of how to kind of avoid the disease, the social distancing, the personal hygiene, the virtual workforce, being able to do that quicker, and being more aware. And then also at the same time, we do have a second wave. If that's in the fall time of next year, we should be closer to a vaccine or an effective treatment. So I do believe there will be some form of a second wave, and no one knows what that's going to look like. However, I also think we're going to be better prepared. Another bullet point that's not up here that's worth mentioning is that a lot of people will already have been infected, so they've most likely will have built up antibodies and are now immune to it, getting it on the second wave. So, and there will be testing most likely coming out to test for antibodies, and if you can go back to work and those types of things. So I think if we do have a second wave, yes, it will probably cause a lot of volatility, but I don't think it will be as bad as the first wave. That's my working theory. That's our working theory right now. So, all right, changing gears. Now, looking here in terms of the stimulus that we have, that the U.S. has done, and what's known as the printing money, the quantitative easing. The chart that we're looking at here is basically the Federal Reserve's balance sheet. So this chart, it goes back to 2008, and anytime we do quantitative easing, this chart would go up. So if the U.S., this is quantitative easing 1, if you remember that back in 2009, and then you have quantitative easing 2, and then you have quantitative easing 3. And then we ended up stopping and starting to normalize from 2015 all the way until kind of 2019 standpoint. And now look what's happened since the COVID-19 has come along. Over $2 trillion worth of quantitative easing over the last few months. An unprecedented amount. None of the other quantitative easing that we did, 1, 2, or 3, was anywhere close to that. So that's meant to stimulate the economy. That's meant to keep interest rates low. That's meant to keep the banks working properly. And I think this time is a bit different. Obviously, a lot of different than the credit crisis. In the credit crisis, there was a lot of problems with the banking industry, and a lot of banks became extremely tight. This time around, it's not. The banks are a lot stronger, but this quantitative easing is put in place to make sure lending keeps happening, business can keep running, and money markets work properly, and all the financial functions work properly. So an unprecedented amount of stimulus. The other part that I talked about is that the Federal Reserve lowered interest rates to 0. What we're looking at here is the Fed funds futures rate, and it basically looks at the probability of future interest rates. And we're looking out, and it's basically, right now we're at 0 to 1/4 rate in terms of the federal funds short-term rate. And we're looking out 1 year from now where interest rates are predicted to be. And I've gone through every single time frame over the last year, and it's 100% chance, as you see right here, 100% chance, no change. So that's the probability of interest rates going up over the next year. My point being is that low interest rates are expected for a long time period. And good and bad, and I'll talk about some of the good parts and the bad parts about that, but that is meant to stimulate the economy. So the 10-year Treasury yield is down to 0.63% right now, which is a level we haven't seen in ever, actually. It's one of the lowest of all time in terms of yield of the 10-year Treasury. And I just noticed a typo. That is not mortgage, that's Treasury. You can see this is the 10-year Treasury rate. But if we flip over here, a lot of times the 10-year Treasury rate it determines where mortgage rates are. And here's the mortgage rate. So if you look here, this is a 30-year mortgage rate. It hasn't come down as much as the Treasury yield. You can see it's at 3.33%, one of the lowest points it's been in the last 10 years, but it hasn't come down as much. The good side of lower interest rates is that maybe there is an opportunity to refinance and get a lower rate. And obviously, I'm not going to get into that deeply right now, as you know, it's important to talk to your financial planner and financial advisor about that. But that's the positive side, and that's really how the stimulus works. When you lower interest rates, it not only lowers mortgage rates, it lowers lending rates in general. So therefore, people save money on that, which allows them to not spend as much in interest and interest payments, but allows them to be able to use that money for other things, which is a stimulative factor. So, you know, I just thought I'd plug on this one. We're big believers of the 15-year mortgage rather than a 30-year mortgage, as you spend a lot less interest over time. But 15-year mortgage rates are at 2.82% on average right now. Now, the bad side about lower interest rates, especially if you're a saver and if you have money in the bank, is you earn almost nothing now in bank accounts and in money markets. So a lot of times money markets are based off of the 1-year Treasury, and you can see the 1-year Treasury rate right now is at 0.19%. Not too long ago, about a year or so ago, you know, in a money market, you could get about 2.3%. That's not happening now. So we're going to have to get used to, again, very low money markets and interest rates for a while now. So now a question I get a lot is, and I mean, my own personal question and concern about all this stimulus. It's obviously meant to get economies going, and it's been very effective actually in the past at kind of stimulating the economy. But what are the negative ramifications for that? And so, you know, one potential negative ramification is a ton of debt. And so if you ever want to get completely freaked out, go to usdebtclock.org, and you can look at basically a really neat, if you're a nerd like me, website that kind of shows you all types of statistics. I've taken out a couple pieces of these statistics to show you right now our U.S. national debt is at $24 trillion. And our, you know, so right now for the U.S.'s fiscal year, we bring in about $3.5 trillion from federal tax revenue, but we're spending $5.6 trillion this particular year with the stimulus. We were already running $1 trillion deficits. Now with this stimulus package that's coming out, the fiscal stimulus package coming out, that's going to be even greater. So it looks like this year, and it's probably going to grow from here, but right now we're running a deficit of 2.1 trillion. Now, a lot of times people confuse deficits with debt. Debt is how much you owe total. Deficit is for what the difference between what you bring in revenue and what you spend. So if you think about it on your own personal budget, if you have a take-home income of $5,000 and you spend $6,000, then you have a $1,000 deficit. Okay, but this is from the federal level, the U.S. government, we have a $2.1 trillion deficit. Now, per year, U.S. gross domestic product, or the GDP as it's referred to, is at 21 trillion. And the reason why that's important is a lot of times countries, to see if they're healthy in terms of if they have too much debt, you can't just look at the dollar amount. Because the dollar amount, I mean, obviously you get in the trillions, these numbers look crazy, but the economy has grown a lot over time. And so, you know, if you look here at the U.S. national debt of 24 trillion, but our gross domestic product at 21 trillion, in the way you measure if you're healthy is you divide the debt by the GDP. And so that's what this chart does. So this chart looks at, you know, even though we have $24 trillion in debt right now, we're actually not at our highest level that we've ever been as a country. And I bring this up to point out, hopefully, a glimmer of hope, and maybe for everyone who is watching this and votes, a little more consciousness about trying to balance the budget over time. But if you look here, you can see in the 1940s, coming out of World War II, we had a debt to GDP of close to 120%. I think after the stimulus package and this full fiscal year goes through, we're going to hit that number again. But which that alone is not good. However, we have as a country come together and lowered that in the past. And hopefully we can do that again in the future and start to work on bringing our debt down. But that's where we are now. So just to summarize everything, to kind of bring it back into kind of what everything is going on with the market and how we've kind of tried to navigate everything is, number one, if you guys have been watching past market updates, is that we have been defensively postured. We were defensively postured going into 2020. And we can't take credit for predicting the coronavirus. We had no idea that was coming. But we happened to see a lot of potential red flags. You had the yield curve that went negative, which is a red flag that usually forecasts an upcoming recession. You had a lot of other, you had a very high value, you had very high valuations in the stock market, so stocks were expensive. So you had a lot of red flags that caused us to go more defensive. The way that we went more defensive is we reduced stocks significantly, and we started buying things that typically go up during bad times. And we talked about that, the long-term treasuries, gold, those are non-correlated assets. So we bought things that typically go up as the market's gone down. And so that helped us navigate this downturn in the market. And then as the market's gone down, the valuations of stocks became a lot more reasonable. In fact, you can make the argument, a lot of them became very undervalued. So we did what's called strategic rebalancing. And strategic rebalancing is where you sell what's gone up in your portfolio to buy what's gone down. And when I say strategic rebalancing, a lot of times people just do that on an annual basis or periodically. We try to do it strategically. So we try to do it when a particular asset class has gone up or down a lot. When we see that that's happened, we will enact a strategic rebalance. We'll implement that. And so we've done that to take advantage of, as the market's gone down, it looks like there's some pretty good deals in certain areas. Let's sell some of our bonds that have gone up, which have gone up a lot, and who knows how much further they could go. And then let's take some of that money and buy some stocks that have gone down. So that summarizes kind of the things that we've been doing, what we're seeing in the economy. It's been obviously a very difficult start to the year, but a lot of stimulus is being thrown out there, not just in the US, globally. And it also looks like the number of cases are going down, the number of deaths, it looked like they've peaked in a lot of places around the world, which could allow the economy to start to reopen. So that's an encouraging sign. And if that happens, a lot of times the market anticipates that and starts going up even before the economic numbers get better. But at the same time, something that we have to be aware of is the amount of debt that we're taking on as a country and the amount of, the high deficits that we're running.
If you haven't done so already, click here to subscribe. We frequently upload market update videos on the coronavirus, provide financial planning tips, and relevant personal finance topics on our channel.